Welcome to the Opening Bell Report.
305%.
In a single trading session, yeah.
And that doesn't even count the after hours action, which pushed it up, another 61%. We're not talking about some crypto coin here.
No, this is a NASDAQ-listed company, Quince Therapeutics, ticker QNCX.
It's just a number that makes you stop what you're doing. I mean, when you see a stock quadruple in about 6 hours,
Yeah.
you automatically assume amazing news.
You assume they cured something. They must have found the cure for a major disease.
Right. But that's the huge paradox here, isn't it?
Yeah.
They didn't cure anything. In fact, just a few weeks ago, they failed. I mean, they failed spectacularly.
It's a fascinating disconnect, a total disconnect between the news and the stock price.
So that's our mission for this deep dive. We're digging into a market research report from February 11th, 2026. It's titled QNCX Explodes plus 305%. Is this the ultimate rebound trade? And we have one big question to answer.
Is it a dead cat bounce?
Exactly. A final spasm from a dying company. Or is this something else? A legitimate repricing where the market broke and then fixed itself?
Right. It really gets to the heart of whether the market is truly efficient or if it sometimes just has a complete nervous breakdown.
I have to start with a skeptical view. Because I look at this chart, I look at the news, and it just doesn't compute. A company fails a phase 3 trial, stock drops 90%, and then it shoots up over 300% because they say they're exploring strategic alternatives. That sounds like pure insanity. It sounds like a trap.
It absolutely sounds like a trap. And, 99 times out of 100, you'd be right to just run for the hills.
Okay.
But this is that one time where you really have to peel back the layers. To get why this isn't necessarily insanity, you have to understand what strategic alternatives really means, what it signals.
Right. Okay. So in plain English, strategic alternatives is usually just corporate speak for we give up. Someone please buy us.
Exactly. It's a for sale sign on the lawn. And normally admitting defeat like that is, it's bearish. The dream is over. But the report argues that in this specific case, admitting defeat was the only way to unlock the real value.
Unlock value. Their drug failed. What value is there to unlock?
That is the $50 million question, literally.
Okay, let's back up. Let's set the stage. Because you can't really get the rebound without understanding just how bad the crash was.
Yeah.
Take us back to January.
Okay, so January 2026. Quince's big hope is their NEAT trial. They're testing a treatment for a really devastating neurological condition. The hopes were sky high.
And the results came in.
And they were not good.
Yeah.
A swing and a miss on the primary endpoint. But the real nail in the coffin wasn't just their failure. It was that a competitor, another company called IntraBio, announced positive phase 3 results for the same thing.
Ouch.
Yeah.
So not only did their drug not work, but someone else's did. The market's gone.
It's gone completely. It was a zero-sum game, and they got the zero. The market reaction was, well, it was violent. The stock dropped about 92%. It went from being a real biotech company to trading for like 13 cents a share.
13 cents.
Yeah.
At that price, the market is basically pricing it for bankruptcy.
That's exactly right. And that is where the opportunity, according to this report, was born. The report calls it algorithmic panic. You have to remember, when a binary event like this happens, the trading algorithms, they don't sit around and read the financials.
They sell first, ask questions later.
They sell first, and they never ask questions. They just dumped the stock so hard that it created this bizarre financial anomaly. The report says the whole trade thesis is built on this.
Yeah.
The company was trading at a negative enterprise value.
Okay, hold on. Negative enterprise value. Break that down. That sounds like something from a physics textbook.
It sounds super complex, but the math is actually dirt simple.
Yeah.
And this is the key to the whole rebound theory. Imagine you're walking down the street and you see a wallet on the ground.
Okay, I'm with you.
You open it up. Inside, there's $100 in cash, no debt, no IOUs, just 100 clean dollars.
Got it.
Now, because the wallet itself is old and ugly, maybe it's got a tear in it,
Yeah.
the market decides that the wallet and everything inside it is only worth $12.
So, I can buy the wallet with the $100 inside for $12.
Yes, that's negative enterprise value. The cash sitting in the company's bank account is worth more than the entire company's price tag on the stock market.
That feels impossible. Why wouldn't arbitrage bots just snap that up in a nanosecond? Why was it just sitting there at 13 cents?
Fear. One word. Fear. Specifically, fear of the burn rate. The market was terrified that the management team was going to take that $100 and, light it on fire, funding another crazy drug trial.
Ah, okay. So the discount wasn't on the cash itself. It was a discount on management's future decisions.
Precisely. The market was saying, we don't trust you with this money. They assumed the cash was as good as gone. But then on February 10th, the company puts out that press release, strategic alternatives.
The for sale sign.
Right. And that announcement changed the entire equation. It was a signal to the market that said, we're not spending this cash, we're stopping, we're looking for a deal. And suddenly, the risk of them burning through all that money just it evaporated.
So the 305% jump wasn't hope for a new drug. It was just the price snapping back to reality, acknowledging the cash in the bank.
It was a fundamental repricing. The report estimates Quince had between $50 and $60 million in cash. Before that rally, the entire company was valued at about $7 million.
Wow. $7 million valuation for $50 million in the bank. That really is buying a dollar for 12 cents.
So when the stock shot up to 53 cents and then up to 85 cents after hours, it was just the market waking up and realizing that 13 cents was completely irrational.
But let's do the math on that. If there's roughly 50 million in cash, and for easy math, let's say 50 million shares, that puts the cash value at around $1 a share.
That's about right, yeah. The report pegs it somewhere between $1 and $1.20 per share.
So even after this massive jump, you're still basically buying a dollar for 50-something cents.
Correct. You're still getting it at a huge discount to its cash value.
So why isn't it at $1 already? What's the catch? Is there still a discount because something is lurking there?
Well, the money's there. The balance sheet is audited. The discount exists because of the risk of what it is now, which is a shell, and the risk of the burn.
Okay, let's talk risks, because there is no free lunch. If I can buy a dollar for 50 cents, there has to be a reason.
The catch is that Quince isn't a business anymore. It's a shell company.
Define that for us in this context, because when I hear shell company, I think of shady dealings.
In biotech, it's a bit different. It just means they have a public listing, in this case on the NASDAQ, they have a pile of cash, but they don't have any real operations that generate revenue. They're just a vehicle waiting for a new driver.
And the value of that vehicle is what?
The reverse merger. This is a huge thing in the biotech space. Think about it. There are hundreds of promising private biotech companies out there. They need to go public to raise the massive amounts of money you need for, say, a phase 3 trial.
And a traditional IPO is a total nightmare.
It's a nightmare. It takes forever, costs millions, and if the market gets choppy, the whole thing can fall apart. But if a private company merges with a public shell like Quince, they get to bypass that whole process. They become a public company overnight.
They basically just take over Quince's NASDAQ listing.
They get the listing, they get the $50 million in cash to fund their own trials, and the original Quince shareholders get a small piece of the new combined company.
So Quince is valuable because it's like a VIP ticket to the public markets.
A clean ticket, yeah.
Yeah.
But, and this is a very big fund element, but finding that partner takes time. And while they're looking for that partner, the clock is ticking.
The burn rate.
That's the single biggest danger to this whole thesis, according to the report. Even with the trial shut down, they still have overhead, salaries, rent, legal fees. The analysis estimates they're burning through more than $10 million per quarter.
$10 million a quarter. That's over $3 million a month they're burning.
So go back to our wallet analogy. You've got the wallet with $100 inside, but every month that it sits on your desk, someone reaches in and takes out $7 and just sets it on fire.
That creates a ton of pressure. If it takes them 6 months to find a merger partner, that $50 million could be down to $30 million.
Exactly. The cash value is literally a melting ice cube, and that's why the stock still trades at a discount. The market is pricing in the time it will take to get a deal done and how much cash will be left when it happens.
That makes perfect sense. So the price today is the market's best guess at what the value will be after you subtract the future burn.
It's all a probability game at this point.
Let's shift to the technicals for a second. The report talks a lot about volume and gap fills. I know some investors roll their eyes at chart reading, but in a weird situation like this, the chart tells a story.
It's critical in a distressed play like this. The report points to the trading volume on February 10th. It was just explosive.
And what does that tell us?
Volume is like a truth serum. If a stock jumps 300% on really low volume, it's probably just a few retail guys messing around. It's a fake out. But when you see tens of millions of shares trade hands, that's institutional money. That's the big money showing up.
They saw the math?
They saw the math and they pounced. And this gets to the idea of the gap fill.
Explain that for anyone who doesn't stare at charts all day.
So when the stock crashed back in January, it gapped down. It might have closed at $2 one day and opened at 15 cents the next. That creates this huge empty space, this vacuum on the chart where no trades happened.
It's like a cliff.
Right. And a lot of traders believe that prices hate a vacuum. They tend to want to travel back up through that empty space to retest those old levels. The report argues the stock is trying to climb that ladder right now.
But there's a ceiling, right?
Yeah.
Report identifies $1 as a huge resistance level.
That dollar mark is massive. Psychologically, it's a big round number, but more importantly, it lines up almost perfectly with that cash per share value we talked about.
So once the stock hits $1, the free money argument is over. You're no longer buying a dollar for 50 cents. You're buying a dollar for a dollar.
And at that point, the whole risk-reward calculation flips on its head. Why would you pay a dollar for a dollar that's actively shrinking every single day because of the burn rate?
You wouldn't? So the upside is pretty much capped. This isn't a stock that's going back to its old high of $4 or $5.
The report is really clear on this. It says do not anchor to that 52-week high. That $4 company had a potential blockbuster drug. That company is gone. This company is just a bank account with a stock ticker.
That's a really important distinction. You're not investing in a dream anymore. You're betting on a liquidation.
It's what separates the traders from the gamblers. The gambler sees it used to be $4 and thinks, to the moon.
Yeah.
The trader looks at the balance sheet and says, the math works up to about $1.10, and then I'm out.
Which brings us to the verdict. The report asks, is this the ultimate rebound trade? So what's the answer?
The answer is a very careful yes, but be quick about it.
Short-term, yes. Long-term, no.
Precisely. For a trader, the momentum is there. There's a potential catalyst coming, like if they announce a specific merger partner, there's still some meat on the bone between here and $1.
But for a buy and hold investor,
stay away. I mean, unless you have some inside track on who they're merging with, you're flying completely blind. And that burn rate is always there, eating away at the value every day you hold it.
the report wraps this all up with an analogy I love. The cigar butt theory. This is classic Warren Buffett, isn't it?
It is, yeah. From his early days, before he started buying great businesses like Coca-Cola.
So break down the cigar butt idea.
Okay, so imagine you're walking down the street and you see this soggy, disgusting cigar butt lying in the gutter. It's gross. Nobody wants anything to do with it.
Not a great visual.
No, but Buffett's idea was if you're willing to pick up that disgusting free cigar butt, there might be one last good puff left in it. And because it cost you nothing, that one puff is pure profit.
And Quince is the cigar butt.
Quince is the cigar butt. The core business failed. The market threw it in the gutter. But that $50 million in cash, that's the one last puff.
And the 300% surge we just saw.
That's the market taking that puff.
And the key is, you don't save the cigar butt for later.
You absolutely do not. You take the puff and you toss it. This is a trade. It is not a marriage.
I think that's such a key lesson. People fall in love with the story, right? They think, oh, maybe they'll find another drug, or maybe the trial data wasn't so bad after all.
That's what traders call hopium. And hopium is a very expensive drug. The math here is cold, it's hard, it's just cash minus burn equals value. Anything beyond that is just noise.
It just shows how inefficient the market can be sometimes. We're always taught that everything is priced in, but this is proof that algorithms can be just as blind as humans.
Well, the algorithms are designed to manage risk, not find value. If their programming says failed trial means sell, they sell. They don't have a subroutine for check if you're selling $1 for 12 cents. That takes a human.
So if you're listening to this and you missed the Quince trade, what's the big takeaway? Why should you care about some broken biotech stock?
The takeaway is that this setup happens more often than you'd think, especially in biotech. The failure rate is incredibly high, so there's a constant supply of these broken companies that get tossed aside but still have a pile of cash.
You just have to be willing to sift through the garbage.
You have to be willing to look for that negative enterprise value. You have to look for the companies trading for less than the cash they have in the bank. It is not glamorous. It's not the next AI revolution. But, you know, the math is the math.
Buying $1 for 50 cents is always a good trade as long as you're sure the dollar's really there.
And as long as you sell it before it burns away.
So the final question I want to leave you with today isn't really about Quince. It's bigger than that. If algorithms are capable of blindly dumping a stock until it's worth 12 cents on the dollar, where else is that happening right now?
That's the billion-dollar question.
Where else in the market is there a pile of free money just sitting there, completely unnoticed? Because the story attached to it is so bad that no one's even bothered to check the math.
It's out there. You just have to be willing to pick up a few cigar butts.
Thanks for listening.
Don't forget to like, share, and subscribe for more.